And I think you've worked on some number on the banks as well.
Well, absolutely. You know, this week was all about the banks as people were assessing the health of the global banks in US and Europe. So the big question now, is there a risk for the Indian banks, right? How do they hold up in light of what we are seeing right now? So first, let's take stock of how the banks performed. This week, the Nifty Bank was down 2.2%. The PSU banking index slipped 4.5%, and individual names, a Bank of Baroda, a State Bank of India, all took a deep tumble. So we're taking a hard look at the health of the Indian banks, and we're evaluating them on 3 key parameters. The first one is the quality of the liabilities, that is your depositors. Secondly, the yield impact on the investment book. Is there a risk of big losses, the M2M losses on the Indian bank's portfolio, on their bond portfolio, due to the rise in the interest rates? And third, the risk to the asset quality. So the first one, let's talk about the bond portfolio of the Indian banks. Now, CLSA says the Indian 10-year bond yields were at 7.5% pre-COVID, early 2019. They dropped to sub 6% during COVID, but now they've rebounded to 7.4%. CLSA's discussions with a few PSU banks suggest that the break-even for an M2M loss for PSU banks is roughly 7.5%. So even if yields go up by another 500 basis points, according to CLSA, the PBT hit is likely to be manageable and at approximately 5 to 7%. So this is on the bond portfolio. Now let's talk about the liabilities. Depositors. Is there a risk of a big outflow of depositors? Something that we've seen in the United States and few of the banks like SVB. Now, Jeffrey says that in India, household depositors constitute more than 60% of the depositors. Now, these are sticky. They don't typically move to GSEC. So the concentration risk in India is very low, and therefore the risk on this front is on the lower side. And the third parameter to look at is the asset quality. Now here, what we've picked up is the mortgage rates in India pre-COVID were 8.5%. They fell to 6.5% during COVID, but now they're at levels of 9%. So the increase of EMI rates in India is not as severe as what we've seen in the Western economies. And therefore, the likely hit to asset quality is again likely to be on the lower side. And plus, the bank's asset quality, the kind of buffers, the contingent provisions that they are sitting on is the best that we've seen in over a decade. Banks themselves are not very worried. You know, this week, Morgan Stanley put out a note in the Indian banking system. They met with a lot of financial institutions, and their key takeaways are that banks are saying that the loan growth is likely to remain healthy. Yes, there will be some NIM moderation next year as funding costs catch up, but the asset quality remains benign. So banks are not worried. Are the brokerages worried then? So here's a quick roundup of the brokerage commentary. Jefferies, in its note this week, says the SVB test on the Indian banking sector holds up again. CLSA says negligible contagion risk, no material impact except for heightened risk premiums. And Macquarie says it's Goldilocks with a minor bump. So that's just a quick summary of what is the health of the Indian banks based on what's happened globally. We need to slip into a very short break at this point, but on the other side, we'll talk about the top management changes that have taken place this week, the announcements on that front, and we'll also invite Hiren Ved of Alchemy.